If you've been watching the markets in recent days, you've probably noticed a little bit of shakiness. Ever since tariff uncertainty emerged earlier this year, investors have been asking themselves, is a recession on the way? And if so, will it trigger a bear market? Today, I want to unpack what we can learn from 15 historical bear markets and what those lessons might mean for investors like us right now. We've been in a bull market since October of 2022, and that puts us at just over 33 months of upward momentum. Now, that's a solid run, but nothing lasts forever, as we all know. While no one can precisely time when the next bear market will arrive, understanding what bear markets look like and which ones hit harder can help us prepare psychologically as well as strategically. Right now, we're in a unique moment. The market is still elevated, but underneath the surface, economic and political signals are mixed, and that could potentially throw off the risk reward balance over the next 12 to 18 months. Let's look at the data. Since 1950, we've had 15 bear markets or near bear markets in the US. And here's what stands out. Non-recessionary bear markets fell an average of 22% and lasted about 3 months on average. That's a bear market without an accompanying recession. Recessionary bear markets, though, averaged a 35% drop and stretched on for about 18 months. So the big takeaway here is that not all bear markets are created equal. If we do hit a downturn, the question isn't just if, but how deep and how long. And that usually depends on whether it comes with a recession. We can more easily stomach a downturn if it recovers quickly, much like a large market correction. But when we lose years of potential growth, that's what really hurts. So let's talk about recession risk. We've seen a lot of economic caution lately. Businesses have been hesitant to hire, but also hesitant to fire. Mixed signals. It's very much a wait and see environment. And because of that, job growth has been slowing. That could be an early signal of trouble if it continues, but here's the twist. In 2022, if you remember, most people feared a recession all year long. It never came. Why? Because when a recession is widely expected, individuals and businesses often act conservatively before things get bad. They're preparing, and that very behavior can sometimes, over a period of time, prevent a recession from materializing. Plus, the Fed also has a key card up its sleeve. It still has plenty of room to lower interest rates if needed, which can help stimulate growth. Another big signal to watch is the yield curve. When long-term interest rates drop below short-term interest rates, we call that an inverted yield curve. It often precedes a recession, but here's the kicker. An inverted yield curve can happen without a following recession, but recessions rarely happen without an inverted yield curve, unless government spending picks up dramatically to counter the slowing private growth, and that's not necessarily a good long-term solution either. Here's why inverted yield curves matter. Banks typically borrow money short-term, and they lend it out long-term. If they're not making money on that spread, they stop lending, or at least they slow lending, and when fewer loans are issued, money stops flowing through the economy. That can trigger a recession. Now, the US yield curve right now is nearly flat. It's not majorly inverted, but close. But globally, many developed countries are actually starting to see steepening yield curves again, which is a positive sign. Let's also talk about valuations. The Shiller price to earnings ratio, which smooths out earnings over 10 years, is currently about 1.23 times its 10-year average. Now that's high, and when valuations are stretched, bear markets tend to run deeper when they eventually do occur. But here's the catch. High valuations don't tell you when a market's going to fall. They just suggest that when it does happen, the decline could be steeper. So what should we do with all this information? Historically, the stocks that tend to hold up better during bear markets share a few traits. Low volatility, high quality, strong dividends. On the flip side, the worst performers tend to be high volatility stocks, typically measured by standard deviation, small and mid-cap stocks, and aggressive growth names. Now, none of this is a guarantee, but understanding these patterns can help you rebalance if you're looking to reduce risk without stepping completely off the field. So, what can we actually do here? First, remember, this isn't a call to time the market. The highest likelihood of long term success is determined by how willing investors are to stay invested, properly allocated based on their risk profile, rather than being all in or all out. But this is a reminder to check your positioning and be honest with yourself about what you're willing to ride through and what you're not. Now, quick disclaimer, what I'm sharing here is for educational purposes only. It's not personalized financial or investment advice. Every investor's situation is unique, and you should consult a licensed financial professional before making any changes to your portfolio. So, with that in mind, here are some practical strategies that can help reduce downside risk in a bear market, even if it's no guarantee of reduced downside. Each bear market is different. An investor could shift toward large cap value or high dividend paying stocks. They could consider buffer ETFs for some downside hedging, which also typically limits upside. They could increase allocation to high quality bonds, though not dramatically straying from their long term asset mix. They shouldn't typically go all bonds or majority bonds if their long term strategic mix is a majority stocks. They could diversify globally, especially across developed markets. And they could keep an eye on volatility levels in their holdings. Are investments performing the way that they're expected to perform based on one's risk tolerance? I'm not forecasting an immediate bear market, but based on where we are today with high valuations, a flat yield curve, and economic uncertainty, taking modest precautions is just smart portfolio management. In the end, it's not about guessing when the next downturn hits. It's about being mentally and financially prepared so that you can ride through it confidently and intentionally, maintaining focus on your long term goals. If you found this helpful, make sure to like, subscribe, and share it with someone who you think would enjoy hearing it. This is Daniel, your co pilot on this financial journey, signing off. Thanks for watching, and I'll see you next time.